learn this, get through it, fill out the forms. You know, you're not at all behind yet. We will tell you when you're behind, and it's not yet. So, okay. So, George, I'm going to pass it off to you. So, let me just give a little introduction to George. I don't know if you guys, so George, you've been in the group for like 2 years?
Up that.
Okay. So, George is a group member, and probably about 2 years ago, he started sharing his spreadsheet, which is a very, very detailed spreadsheet of the EFC calculation. And I think a lot of people, you know, loved seeing that. And it really, if you use it, you get a much better understanding of how the calculation works. Admittedly, none of us like the results, but at least you get an understanding of where it's coming from. So George has been doing this for a few years, and I thought I would love for him to present, you know, to everybody with his knowledge. And I think, and I've been through this presentation, he really knows how this formula works. And I think you'll learn a lot. Again, we might not like what we're learning, but at least you'll have an understanding to know how things are calculated and what that number means when you finally get it, when you fill out your FAFSA. So thank you, George. Maybe even if you want to maybe give a little background about what you do in your normal life, because this is not your normal life. You don't,
Sure.
that would be, I'm sure people would love to hear that.
Sure. Can folks see my screen?
Yes, I think so.
Okay.
I can see it. So if anybody can't see it, just let me know or put it in the chat.
Great. So thanks to everybody for coming tonight and giving me the opportunity to speak. So yeah, as Debbie said, this really has very little to do with anything I do professionally. I work in educational technology mostly, but related to K-12, nothing to do with college admissions for the most part. But a few years ago, as part of my college planning process, my oldest is now a senior. One of my steps was starting to try to figure out what our family's EFC was going to be. And one of the first things I learned was that the formula is published every year by the education department. So I got that. When I started to read it, I found it very difficult to follow. And so I made a spreadsheet so I could figure out what was going on. Initially, it was just for my personal use. So I was hard coding a lot of things like the tax allowance rate for my particular state or the income protection allowance for my family composition. But I realized that I was surely not the only person in this position, and that there would probably be other people who would appreciate this resource. And I realized that it wouldn't be that much additional work to flesh it out so that it would work for people in other states or different family sizes. And the Facebook group provided an easy mechanism to share it with a large audience of interested people. So I did that. And I happen to be a person who gets very frustrated by the dissemination of misinformation. And we live in a time when there is a lot of misinformation circulating generally, and in particular, a lot of misinformation about the FAFSA and the EFC formula. So this seemed like, I don't know, one little corner of the internet where I could perhaps make some headway combating the spread of alternative facts and help people understand something that they were confused by. So when a few weeks ago, Debbie invited me to speak, I welcomed that opportunity. So on to the topic, EFC, what is it and how is it calculated? So let me first talk about my goals for this evening. As I said, I want to explain the calculation, why your EFC is what it is. I will give you a warning up front. I'm not going to tell you how to reduce your EFC. In general, there is no sensible way to do so for most people. I will, however, suggest some things that you should avoid doing because they will unnecessarily raise your EFC. So again, my goal is to help you understand how and what, and also sort of alert you to some potential pitfalls. So in theory, EFC, or expected family contribution, is really an upper limit on what schools and the federal government think is reasonable to expect a family to spend on college as a function of their income and assets. In the world of financial aid and college, the term need gets used a lot. And that in this domain is a term of art. It doesn't mean what you think it means. It means very specifically the cost of attendance, it's a sticker price, less your expected family contribution. That, by definition, in this domain is need. So when a school says that they meet full need, that means that they provide aid for your full need. Depending on the school, that aid may include loans and work study, as well as grants, or in some cases it may be just grant aid, free money that doesn't need to be repaid. The FAFSA EFC in particular, the main thing that it specifically is used for is determining eligibility for Pell Grants. The actual formula is pretty complicated and based on a table, but as a very sort of rough first order generalization, if your EFC is less than about $5,700, then you may be eligible for a Pell Grant of up to about $6,300 minus your EFC. So if your EFC is 0, you qualify for the full Pell Grant potentially. And then as your EFC rises, that amount of Pell Grant that you might be eligible for falls until you hit 5,700, which is basically the minimum Pell Grant that is granted is about $600. And at that point, eligibility disappears altogether. Okay. So there's really two types of EFC. There's the FAFSA EFC, which is the formula I'll be talking about tonight, and then there are institutional EFCs. So FAFSA EFC is determined by a published formula. It's set by the federal government. It's uniform. So once your EFC is determined for a given school year, that is your EFC everywhere as far as FAFSA is concerned. Institutional EFCs are determined by each school according to their own formulas. Those are generally not published, so it varies. You could have one institutional EFC at one school that meets need and a different EFC at another school that also meets need. And so whereas the FAFSA EFC determines your Pell Grant eligibility in conjunction with a couple of other factors, it's also a factor in eligibility for subsidized loans for a portion of your federal student loans. Whereas the institutional EFC is what will govern eligibility for institutional need-based aid. So an important thing to understand is that at many top schools meet need and they offer only need-based aid. And so at those schools, EFC should approximate net price up to the cost of attendance. Of course, if your EFC is more than the cost of attendance, then then your EFC doesn't matter much. But if your EFC is less than the cost of attendance at those schools, they should be pretty close. And again, the EFC that really matters here is institutional EFC. And the best way to estimate institutional EFC is to use the net price calculator that each school has on its website. But FAFSA EFC is a helpful starting point. First off, because it's a fully known quantity, it would be impossible to give a talk like what I'm going to give tonight about institutional EFCs because the formulas are black boxes. And it's a good baseline against which to compare EFCs that you get from various other colleges. And for the most, it's very hard to generalize about institutional EFC formulas because they're not published. Anything you can say is not necessarily going to be true all the time. But most of them are structured pretty similarly to the FAFSA formula. They're not identical, but in most cases they will come up relatively close, unless one of several things are true. And I'll talk a little bit about that. There are some things that will cause them potentially to diverge dramatically, but much of the time they are pretty similar, and the FAFSA EFC is a good baseline against which to compare what you're seeing from schools.
George, can I just interrupt for 1 minute just so that people
Please.
maybe know, when George is talking about the institutional formula, that is what is from when you fill out the CSS profile. So, so that's the information that the colleges are asking for in the CSS profile, and then they use it for their institutional methodology to come up with their specific school's version of, you could say, the school version of the EFC.
And the CSS profile is the mechanism that most colleges that meet full need use to gather additional data. There are a handful of colleges that actually will come up with an institutional EFC based just on the FAFSA data. There's also a few colleges, Princeton is one, that have their own forms. They don't use the CSS profile. And one a big thing to understand about the CSS profile is that it is not a EFC formula. It's really a data collection tool, unlike FAFSA, which is both a data collection tool and a CSS formula, or excuse me, an EFC formula. There are two formulas baseline formulas that a lot of CSS profile schools used. They're called the institutional methodology and the consensus methodology, but I'm not going to be talking about those because I don't really know what they are, other than because they're not published again. And even schools that use those often then take that as a starting point and make their own changes. So even if you did know exactly what the formula was, it would be of limited utility. So before I move on, I want to make a couple of caveats. The first is to remember that most schools do not meet need. We're really talking about a couple of hundred of the most selective, best endowed schools in the country. And even amongst those, as you get down the list in terms of their endowment more than anything else, they're more likely to include loans in their age packages for many families, especially at the upper end of the income spectrum. For even if you're a lower income family, even schools that include loan packages are probably not going to package a whole lot of loans for you. But if you have more resources, then they will. All the schools that meet need have competitive admissions. They're not all Stanford. There's plenty of them that are plausible, not insane admissions, but you have to have a strong academic record to be a credible candidate at pretty much any of the schools that meet need. Another thing to understand is that many schools that do meet need have what's called need-aware admissions. And what that means in practice is largely that they have a cap on the number of offers that they can make to applicants who have significant need. There was a great article in the New York Times a while back. I think it's called "What Colleges Really Are Looking For," or something like that. The authors spent some time in a guidance in an admissions office at one of these schools, and sort of details their agonizing decisions of they have 10 kids they really want to admit, but they only have enough because they are committed to meeting need. They only have enough aid to admit 5 of them. So if you don't need, you have a leg up at admissions at need-aware schools. Other schools that have more money are need blind, although in many cases those schools still admit an awful lot of very well-off students, even though they are, at least in theory, need blind. So as a result of all of that, most families that have very low EFCs actually spend more than their EFC on college, because most kids from lower income families they're not going to Princeton or Yale. They're going to the big state schools or and those schools don't have the resources to meet needs. So in many cases, people, if you have a lower EFC, you'll qualify for a Pell Grant. You may qualify for state grants, but that will often not bring you anywhere close to the cost of attendance. And finally, many families who have high EFCs will end up spending less than their EFC, either by picking a school that just has a lower price, like a public in-state school, or a school that offers so-called merit aid, where your EFC is not going to be much of a factor in your eligibility for aid. Okay, so with that background, so the key takeaways before we dive into the formula. For lower to moderate income families, the high sticker price schools that meet need are actually likely to be the lowest net cost option. The really hard part is getting in. For mid to upper income families who are not part of the 1%, if you will, meeting EFC is likely to be challenging. Schools that are the most generous with need-based aid usually offer the least merit aid. As I said, many offer none, including the entire Ivy League. So families can really only consider those schools at all if they are willing and able to meet their institutional EFC. So that's something that's worth sort of bearing in mind. Okay, so again, although few families will end up paying their EFC, knowing it is a really key data point in narrowing your list of target colleges. A family's FAFSA EFC will often be in the same ballpark as their institutional EFC, although institutional EFCs vary and a number of factors can cause them to diverge dramatically. But since the FAFSA formula is published—
Can you check the speaker? Sorry. If let's see, who's that? If
Are,
somebody,
are people not able to hear?
no, we can. Oh, did somebody say
The
they want?
speaker's not working.
No. It just says you're muted.
I
People-
cannot hear.
Okay, go ahead, George.
Could people raise their hands if they can hear me? Okay, so it looks like most people can hear me. So I think whatever is going on there must be something on your system. But thank you for letting us know. So again, it's not possible to give a talk like this about the institutional EFC formulas, but I can give a talk about this, about the FAFSA formula, and then you can see how close the institutional formulas come out to it. So the basics. Let me say at the outset, I'm talking here about the dependent student standard formula. The independent students are a different set of rules that they're not that different, but I'm not going to go into that at all, and I haven't done a spreadsheet for that. So this is for dependent students, which is typically college-age students, in almost every case are considered dependent students. So the EFC is derived by applying tax bracket-like assessment rates to your income and assets as determined by FAFSA rules. So there are 4 components, really a 2x2 matrix. So there's the student part and the parent part, and the income part and the asset part. So we end up with student income, student assets, parent income, parent assets. Student income is assessed at 50%, but only when it's over about $7,000 a year. Student assets are assessed at 20%. That's the period. Parent income is assessed at a sliding scale with rates that go up to 47% of your after your income protection allowance, which is an income protection allowance I'll talk about more later, but as an example, for a family of 4, that's about $30,000. So above that, your income is assessed, and the marginal rates go up to 47%. Finally, parent assets are assessed at a sliding rate with marginal rates up to 5.64%. So before I dig down on any of those, I'm going to spend a minute to talk about what FAFSA means by parent. So if the parents are married to one another or they live together, it's simple. They both count. That's sort of a common sense definition of parent. However, if the parents are not together, whether they're separated or simply unmarried, and not living together, then you report data only for the parent with whom the student currently lives, or lives more if the student spends time at both of their homes, plus that parent's current spouse. So basically, FAFSA doesn't know that there's such a thing as joint custody, or doesn't care. In the world of FAFSA, there is a custodial parent and a non-custodial parent, and they only care about the custodial parent, which is crazy. That's probably the single biggest divergence between the FAFSA formula and most institutional EFC formulas, is that the vast majority of schools that provide generous need-based aid that meet need are going to ask for your financial information from both of the parents, and typically both of those parents' current spouses where relevant. You can often get a waiver in the event that the non-custodial parent is really absent. They're not present in the student's life. The schools will often waive this requirement. But from a FAFSA perspective, your parent is the parent you live with the most, and that parent and that person's spouse, and the other parent doesn't even cannot submit a FAFSA for the student, which is bizarre but true. Okay, so I talked about the 4 components. Generally speaking, the parent component will be much larger than the student component. And that's not a function of the formula. That's just a function of the fact that the parent's income and assets are typically much higher than the students. So in most cases, the parent component is going to dominate. The student component will be just a footnote. Similarly, for parents, in most cases, the income component is going to be much larger than the asset component. And the first reason for this is that basically most assets are excluded from the formula. I found something on one of the Fed's web pages saying that for households with a net worth of up to a little bit under $500,000, 80% of household wealth is in the form of home equity or retirement accounts. Well, home equity and retirement accounts are the 2 primary exclusions from FAFSA. So for most people, 80% of their wealth is not even considered. On top of that, the income assessment rates are more than 8 times higher than the asset assessment rates. So unless you have a lot of assets, I'll be going into this in more detail later, unless you have a lot of assets, it's really your income that is going to dominate the EFC formula.
George, can I just, so going back, and you said this earlier, that it's actually really kind of hard to change your EFC, particularly, if at this point in the process, if you have a child who's in 11th or 12th grade. And so I just bring that up because if you see an advertisement, if you see somebody saying, I can help you, really,
a lot of snake oil salesmen out there.
yeah, I can help you, hide this money, or, and we'll reduce your EFC significantly. I would be very hesitant, to really believe what they have to say. That's just a consumer warning.
It's like good advice. So I'm going to start with the student asset component, mostly because it's by far the simplest EFC component. Student assets are assessed at a flat rate of 20%. There is no asset protection allowance. Every dollar is assessed. Student has $1,000. That's $200 added to the EFC. Student retirement accounts, however, just like parent retirement accounts, are exempt from assessment. Okay. Parent assessment rates. So the whole process works a little bit differently for parents versus for the student. So instead of having a separate income and asset rates for parents, what they do is take 12% of your so-called available assets, which I'll talk about in a minute. They add it to your so-called available income, which again, I'll talk about in a minute. And the sum, which is very confusingly called adjusted available income. And I say confusing because adjusted available income actually includes a portion that's not income at all. So what adjusted is modifying the whole thing, available income. It's not adjusted modifying your income. It's not adjusted income. It's adjusting your income by adding a portion of your assets to it. And that is the number that those assessment rates are going to be applied to. The assessment rates function just like tax brackets, but they're much higher and they max out at much lower income levels. So the starting rate for the first dollar is 22%. The assessment rates max out at 47%. For reasons that I'll get to in a minute, they generally are being applied to after-tax income. So when I say 47%, that's not 7% of your gross marginal dollar. It's 47% of your net marginal dollar, mostly. That's not 100% true, but mostly. And so as a result of that, the effective maximum asset assessment rate is 5.64%. That's just a result of, that's just 47% of 12%. So they're taking 12% of your available assets, lumping that together with your income, and then assessing that at rates of up to 47%. So that's where that 5.64% number comes from. So what does FAFSA income include? So the starting point is AGI, adjusted gross income from your tax return. And basically, if it's in your AGI, it's in your FAFSA income, unless it falls into one of several categories. These are lines 91A to 91F of the FAFSA form for parents, 43A to 43F of the student form. Similarly, if it's not in your AGI, it's not in your FAFSA income. Again, unless it falls into one of these various categories. These are reported on lines 92A to 92H for. So these are things that they're not in your AGI, but they are in your FAFSA income. For students, but not for parents, gifts are also reportable, with the exception of gifts from the student's parent, meaning FAFSA parent, which is kind of obvious. If the parent who's being essentially assessed and asked to contribute many thousands of dollars, then spends those thousands of dollars on the student, that's not treated as student income. That would make no sense. That would be a double assessment. However, it does include distributions from a 529 owned by a non-parent. And remember that in this context, a non-parent could be a non-custodial parent, as well as a grandparent. It includes bills that are paid on the student's behalf. For this reason, if you have a grandparent who is considering giving generous gifts to help the student attend college, they might want to think about giving that gift to the parent where the income will not be assessed, rather than to the student where it will be assessed. But it should be noted that you can't do that with a 529. If the grandparent owns a 529, when that money comes out of the 529, it's classified as student income. There's no option of giving the 529 money, dispersing that to the parent instead. That's not a thing. Okay. This is just an aside. So FAFSA comes in both an online web form version and a PDF version. you'll almost only want to use the online version to file. But I would really suggest using the PDF version as a reference. It's just 10 pages. It's easy to navigate. All the instructions on the direct and the fields are there in one place. So like in the last slide, I referred to line 92H. It's easy to find on the FAFSA PDF. Just Google FAFSA PDF to find it. That will really, like 80% of questions people ask in the group about FAFSA, you could answer by looking there. And it's a lot easier to find answer there than in the online version, which is kind of hard to navigate, for at least if you're looking for instructions. Okay, so here's the formula. So available income basically is AGI plus certain non-taxable income minus certain excluded income minus tax allowances minus income protection allowance. That's available income. Adjusted available income is available income plus 12% of assessable assets. That's adjusted available income. Okay. So the spreadsheet. I have a bit.ly link here. If you haven't opened it before and you want to open it now, feel free to do that. Should be able to. I think you can. I don't think we'll let you click on it, but this link hopefully is short enough to write it down. I would suggest you do that now if you don't have the link in front of you, because we'll go. On the sheet, basically everything that's where the label is in pink, those are things that contribute to that increase your EFC. So your AGI, the categories of non-taxable income, and again I referred to those by line number earlier. The spreadsheet includes those line numbers. One thing that makes all of this perhaps more complicated than it really needs to be is that the FAFSA form does not include the formula. Conversely, the book that explains the formula doesn't include all the FAFSA lines. And so I've included both references to the EFC formula, which is this E column. It has line numbers, and those are different from the FAFSA line numbers. That's the F column. And to really understand everything that's going on, unfortunately, you need to look at both of those. Okay, so the pink are the things that will increase your EFC, like income. The green are things that will decrease your EFC, like tax allowances and the income protection allowance. And the blue, the light blue, is the results of the calculations, basically your EFC, your available income, and so forth. There's one other piece of color coding going on.
Oop, George, I don't know if you can hear us. I think you froze. Oh, George. Okay, everybody, let's just hold tight.
Depending on your circumstances.
Oh, but George, sorry. Can you rewind like 2 minutes? You froze.
Oh dear, I'm sorry about that. Tell me what you last heard.
Honestly, I was.
The result.
There's one other color.
So the pink. So pink is the inputs that will increase your EFC. The green is the inputs that will decrease your EFC, and the light blue is the output of the formula. And then in terms of the boxes themselves, everything that's an input, things that you're supposed to type in your own numbers, is either yellow or this teal color. And yellow are the most frequently needed fields, the things that apply to almost everybody. And teal are the somewhat more obscure fields that in many cases just won't apply to you, and you can leave them as 0. Okay.
George, maybe we can look at it later, but the bit.ly link you gave is not valid.
Huh.
It worked for me.
Make sure you're typing it right.
It is valid. Just type capital FAFSA.
Yeah, it may be case sensitive.
Oh.
I didn't realize that, but why don't I see if I can copy it into the chat, actually. Then everybody can should be able to get it. the chat out? Can anybody advise me on, well, I can make the chat
And
appear, but I'm
it
not
might
seeing
be too hard, George, because because like when Zoom takes over.
Okay, if anybody who has who has that link working could maybe post it in the chat, that would be great.
Yep,
Because
it's
I
there.
don't seem to be having. Okay,
It's there.
great. Thank you very much. Okay, so let me talk about the FAFSA income categories. So AGI, if you do your own taxes, you already are familiar with AGI. That's salary income, net business income, taxable dividends, interest, capital gains, taxable retirement account distributions. So that's the starting point for your FAFSA income. As I said, then there are certain types of non-taxable income that are added to your FAFSA income. Probably the biggest one here are tax-deductible IRA, tax-deductible retirement account contributions. So that's 401k and IRA contributions. From the tax perspective, if you are contributing a bunch of money to your IRA or your 401k, that reduces your taxable income and leaves you with so it doesn't affect your take-home pay as much as those contributions would seem. It does not reduce your FAFSA income, and therefore it does not reduce your EFC at all. In fact, indirectly, if you have a lot of those contributions, they will indirectly increase your EFC because they decrease your the taxes you pay. Untaxed retirement distributions. This is a pretty big one too. Some people suggest using a Roth IRA to save for college, and you can do that. And there are to some extent, you can take penalty-free withdrawals from a Roth IRA to fund education. However, they are still treated as income, and so if EFC matters for you, if you don't get the timing just right, using Roth IRA distributions can be a big hit to your EFC. It also includes tax-exempt interest, so interest that you're not required to report on your tax return. You still have to.
Oop. Uh-oh, George. I don't know if again you can hear us, but you froze. George.
Can you hear me?
Okay, now we
Hello?
can, but we
What was
kind
the
of
last thing that I said?
Untaxed retirement.
Untaxed retirement. Okay, so I talked about how Roth IRA withdrawals, even though they're not taxed and they may be penalty free, they will be treated as income for FAFSA purposes, even if you use that money for education. So that's a sort of a pothole to avoid. Then there's various other categories of non-taxed income that are considered income by FAFSA, like military personnel, housing and food allowances, workers' comp, most disability benefits, although not Social Security or SSI, that is exempt from assessment by FAFSA. Finally, there are certain types of income that are removed from your AGI. So even though you may be paying tax on them, they're not considered by FAFSA. They do not increase your EFC. Probably the biggest one here is child support that you're paying. So if you're paying child support, that is deducted from your income before FAFSA starts to assess it. The other big category there is all kinds of income that is related to education in a direct way. So work-study income, co-op pay, scholarships are usually not taxable, but even where they are, that even though that is taxable income, it doesn't count for FAFSA purposes. So that's kind of a big deal for student income in terms of helping students to not hit the threshold beyond which their income is assessed. Because if they're earning money through either work study or through co-op pay, that's not counting for FAFSA. Then we have the tax allowances. These function just like deductions in the income tax system. So these are amounts that are directly removed from your FAFSA income, which makes sense. Basically, if your money that you're paying to the tax man is not available to be paid for tuition. So for federal income tax and Social Security tax, these are very straightforward. It's just the amount that you pay. For state taxes and what they call the state and other tax allowance, it's a little bit different. It's basically a state-based estimate. So every state has a different percentage that gets applied. That's a rough ballpark of what people might be paying in state taxes in that state. And that gets deducted from your income, regardless of what you are actually paying in state taxes, whether those are state income taxes or other sorts of taxes. Okay. So the income protection allowance, this is roughly analogous to the standard deduction in income tax. This is an amount that's basically set aside for meeting the basic needs of your family. As you can see from the numbers, they are basic indeed, and they do not vary with geography. So, for example, a single parent with one child, the income protection allowance is a little bit under $20,000. For a family of 4 with one college student, it's a little bit under $30,000. This is a point where many institutional formulas do, again, diverge. Again, I don't know what the numbers are, but there are certainly colleges that make allowance for different cost of living areas and basically have what is in effect a higher income protection allowance or whatever the equivalent is in their formula for people who are living in a high cost region like New York City metropolitan area or almost anywhere in California. For students, for dependent students, the income protection allowance is very simple. It's $6,970. In practice, students can actually earn a little bit more than that because of the payroll tax allowance. So, if you earn that much, a little bit of that is going to payroll taxes, even though students don't usually pay income taxes. Again, work study and co-op income don't count. And then once a student hits that threshold, any income above that amount is assessed at a flat rate of 50%, unlike parent income where the rates kind of build up gradually. Okay.
So George, there's been a lot of questions about unemployment insurance. How is that treated?
I don't know the answer offhand. I believe that is counted.
As income?
I believe it is, yes. I'd have to check to be sure. One thing I haven't said up to this point that I probably ought to say is that if your income is less than $50,000 and you meet certain other criteria, which I'm not going to go into, but many people do, especially if your income is under $50,000. If your income is less than $50,000, then you may qualify for the simplified formula, which is basically it's the same formula for income, but it ignores assets. So in that case, you don't have to report your assets, and they don't contribute. As I'm about to demonstrate, in most cases that really doesn't make a big difference. But in some cases it can make a great deal, a tremendous difference, but not usually. So I've run through a number of scenarios here. So the first column is household income, or parent income, really. The second column is going to be federal income tax. And these are very rough ballparks of what a family might pay in that with that income if they have basically if they don't itemize their deductions. It's just looking at the standard deduction. So most families will actually pay less, which will actually mean that their EFC is a little bit higher. For each family, I've given them assets which increase as they're based as a percentage of their income, but I've increased that percentage as their income goes up. And then the next column, the so-called adjustment. This is basically, earlier I said that they take your income and they add to it a fraction of your assets to come up with your so-called adjusted available income. So this is the amount of that adjustment. Then the EFC. Finally, what the EFC expressed as a percentage of income, and then finally the adjusted available income that EFC was based on, and the marginal rate that applies in that situation. So this first family, their income, and all of these scenarios assume a family of 4, 1 student in college, 2 employed parents. The older parent is 50, living in a medium tax state like Ohio, which is right in the middle of the tax rate distribution, according to FAFSA at least. And all of these numbers would change a little bit if I adjusted any of those variables, but not a huge amount, but some.
Sorry, George, is the income numbers that you're showing for the examples, are they after tax or gross?
No, these are gross. This is gross household income. So our first family, the first 2 rows are kind of significant numbers, and then the rest of them are more arbitrary. The first number is a family this is the most income that a family could have in this scenario and still have a 0 EFC. So this is a family that qualifies for the maximum Pell Grant, but if their income were a little bit higher, they would still qualify for a Pell Grant, but it would no longer be the maximum. They would no longer have a 0 EFC. If their income were lower than this, the EFC doesn't go below 0. There's no such thing as a negative EFC. So this is the richest you can be and still have zero EFC. So their income is, their gross income is $40,000. They're paying $1,600 in federal income tax. I'm giving them assets of $4,000, which is 10% of their income. Their adjustment is zero. That's below their asset protection allowance. Their EFC is zero, and their adjusted available income is actually negative. Basically, the government is saying that like they don't have anything left over to spend on college, and so their EFC is zero. The next family, the next row, is right at the cusp of Pell Grant eligibility. They're actually like, this is sort of almost mythical point where if their income went up by like $10 even, they would lose their Pell Grant eligibility. It's basically impossible to predict what this point is in advance, and it's going to vary with all these things. And you know, they're only losing about $600 in Pell Grant eligibility, but they're right at the cusp of that cutoff. And so for the scenario, for the assumptions that I mentioned above, that cut point is an income of about $72,100. I've given them, again, 10% of their income as assets. That results in a $25 increase to their income, as it were. So again, you can see that's pretty trivial. And their EFC is basically 8% of their income. Now we bump things up. The rest of these numbers are just, you know, sort of pulled out, you know, they're just arbitrary numbers. But at 100K household income with $15,000 in assets, assets are now bumping the income up by $1,000. So it's still basically only equivalent to 1% of this family's income. And their EFC is about $15,000, about 15% of their income. So the thing to note here is how very nonlinear this is. You know, we went from $72,000 to $100,000. So that's an increase of well under 50%. But the EFC increased threefold, almost. Similarly, as we bump up another 50% increase to 150K, now we're looking at a doubling of the EFC to over $30,000, almost $32,000. So it's, the other thing to note is that that family at $100,000 has already hit that marginal rate of 47%. So from there on out, every marginal after-tax dollar is getting assessed at 47%. And so by the time you hit $250,000, or the last row, you have an EFC that is pretty close to $70,000. Even at the most generous schools, a family at that income range is going to get little to no grant aid. Okay. So how much of your EFC is due to your assets? Ultimately, that really boils down to what are your assets as a percent of your income. If your assets are equal to 10%, if your assessable assets, again, remember, because this is excluding your home equity, it's excluding your retirement accounts. But if your assessable assets are 10% of your income, then basically 1% of your EFC is accountable of that. I'm actually ignoring the asset protection allowance here. If I included it, these numbers would even go down a little bit. But it's so low in most cases that it's a very reasonable approximation to ignore it, which is the only way it's possible to do this calculation. If your assets are 20% of your income, still just barely over 2% of your EFC is coming from your assets. 50%, now a little bit, we're hitting almost 6%. If your assets are equal to your income, okay, 11%, still not a great deal. For your assets to be responsible for a third of your income, they have to be more than 4 times, for a third of your EFC, they have to be more than 4 times what your annual income is. Again, this is gross income. And for your assets to account for fully half of your AFC, they have to be 8.3 times your income. So from these numbers, I think you can see why it is that, you know, in the vast majority of cases, assets are a minor, almost a trivial part of your EFC. Again, and that's why when I said that, you know, in most cases that simplified EFC formula that is available to many families with income under $50,000. If your income is under $50,000, you probably do not have a whole lot of assets. It's hard to build wealth when your income is at that level. And so there in most cases that's not actually, that's going to make the form easier to fill out, and it might improve their EFC a little bit, but it's usually not going to make a big difference. And I guess I should have held off on talking about that until I hit this slide. So I will talk briefly about the other criteria. So I said in order to qualify for the simplified formula, your income has to be under $50,000. You also have to satisfy one of several other criteria. Either the household receives need-tested federal benefits, that could be SNAP or free and reduced price school lunch or WIC, really any of those federal need-tested benefits. Or if the parents' federal taxes were pretty simple, basically if they don't have to file a Schedule 1, or they only had to file a Schedule 1 for one of several reasons that are listed, or they weren't required to file a federal tax return at all, or the parent is considered to be a dislocated worker. So if any of those criteria apply, then and your income is under $50,000, then you don't have to report your assets. So now I want to talk about timing considerations related to income. So FAFSA income, you'll hear people talk about prior year. I don't love that phrase because it kind of glosses over the fact that FAFSA income is by calendar year, whereas FAFSA is for a school year, not a calendar year. So when you complete the FAFSA for school year 2021 to 2022, which is the FAFSA you're completing during this school year, 2020 to 2021, that's always based on calendar year 2019 income. As a result, assuming a student doesn't take a gap year, freshman EFC will be based on the income that was received between January of their sophomore year of high school and December of their junior year of high school. Now, for this reason, if you are on assuming a conventional fall-spring academic schedule, if a student is has a traditional four-year path to graduation, any income received after January 1st of sophomore year of college is never going to hit an undergraduate FAFSA. If the student takes 5 years, then it's any income received after January 1st of year 3. And so this is important for the sorts of income, and I put that in quotation marks because these are things that you may not think of as income, even though they are considered to be income, but the sorts of income where you have control over the timing. Things like grandparent 529 disbursements, Roth or traditional IRA withdrawals. If you time those right, then they may not affect your EFC. Now, for the parent withdrawals, you also have to worry about younger siblings, if any. So that may not be a path out of that situation for if the parent is the one doing the withdrawal. But for grandparent 529 disbursements where it's considered student income, you don't have to worry about siblings because it's only that student's income. And if you time it right, then that will not increase the EFC. Now I'm going to talk about asset classes. Let me check the time. Okay. So the default is that assets are assessed in full. This includes cash, bank account balances, stocks, bonds, savings bonds, mutual funds, assuming that they're not in a retirement account. Assuming that they're in a regular account or a 529, includes all real estate equity other than your primary residence, which is excluded, and it includes all 529 balances. And I say all, that's all the 529s that are owned by the parents, which is, in most cases, 529 has a parent owner and a student beneficiary. And so if you have 529s that are intended for your younger children, your younger siblings of the student for whom you are currently filling out a FAFSA, you will have to report those balances. There is a potential way around that, but it actually probably in most cases doesn't make sense, partly because, again, those balances are assessed at a very low rate. Not assessed at all, retirement balances, IRAs, 401ks, et cetera, home equity for your primary residence if you own a vacation home or a rental property, that does get assessed. FAFSA also does not look at life insurance. It doesn't look at movable physical assets like vehicles or art. And eligible family, business, and farm assets are also not assessed. Is there anybody who's maybe could mute somebody? I'm getting background echo. Thanks. I said I'm not going to go into the rules here about what is or is not an eligible family or business or farm asset. But even non-eligible business and farm assets get very favorable treatment compared to other assets. They're partially exempt. not a factor in the FAFSA calculation directly is debt, with the exception of debt that's linked to an asset. So if you have a mortgage on a second home, that mortgage will be accounted for in computing your equity in that asset. But the debt itself and any unsecured debt is not a factor. So home equity, I want to talk about institutional EFCs. So this is one of the other really big points of difference between many institutional EFC formulas and the FAFSA formula. So some institutional EFCs formulas also ignore home equity, just like the FAFSA does. Some of them assess it in full. Some of them assess it but apply a cap. That's usually expressed as a multiple of income. 1.2 is a common, but by no means the only number that's used. So for example, if you had $100,000 in income and $500,000 in home equity, say, at many schools they would assess that equity, but only up to $120,000. So most of it would be ignored. And it's very hard to know unless the school tells you or you play around with the sort of try and reverse engineer the MPC. It's hard to know what different schools do. There are lists you can find on the web. I don't know how accurate they are, how up to date they are, but if a lot of this is something you may want to investigate because it can make a big difference in your EFC at different schools. So the parent asset protection allowance, as I said, assets are only assessed to the extent that they exceed your asset protection allowance. The amount of this is determined by the older parent's age and by whether there is a second parent in the household. For example, if you have two parents and the older one is 50, you get a $7,000 asset protection allowance. That would only reduce your EFC by at most less than $400. So again, in most, you can really just ballpark what the asset protection allowance is by ignoring it. Its effect on EFC is always close to zero. And students don't receive an asset protection allowance at all. So I talked about income timing considerations. I also want to talk about asset timing considerations. So asset values are as of your FAFSA filing date. So if you have large expenses coming up, it makes sense to spend the money before you file. However, spending down account balances in order to lower your EFC is pretty much never a good idea. If you spend $20,000, that's going to reduce your EFC by at most about $1,100. And meanwhile, you have $20,000 less available to pay for tuition. A possible exception to that is if you're using cash to pay off debt. So if you have a $30,000 car loan and you also have $30,000 in the bank, as far as FAFSA is concerned, that you have $30,000 that's going to get assessed for up to a $1,700 EFC contribution. If you take that money and you instead pay off the car loan, it doesn't change your net worth, but you now have a $1,700 lower EFC. So that could make sense. So just be very careful if you choose to do that about leaving yourself with inadequate cash to cover either educational or emergency expenses. So what if a family has two students in college? So the answer is going to be different for FAFSA and institutional EFCs. For student components, actually, the answer will typically be the same. It's going to be calculated separately for each student. It doesn't matter that you have two students in college at once. Parent component, however, for FAFSA, the parent component that we've talked about so far is going to be apportioned evenly amongst all the students. So for example, if a family, if their EFC, if they have one student, it works out to $30,000. If that changes just two students, now it's $15,000 each. Three, $30,000. So the total is the same. The individual EFCs change. Institutional EFCs typically do something kind of like that, but they're not offering as big of a so-called sibling discount. So whereas FAFSA would expect you to pay basically 50% of the one student parent contribution for each of two students, institutional EFCs are typically going to put that at closer to 60%. So the total, instead of your total being 100% of what it would have been with one, maybe there will be 120% of what the EFC would have been for just one. So you're still getting a significant discount relative to just one student, but not as generous as FAFSA. So the $75,000 question: how can I reduce my EFC? For most people, you really can't. Again, income assessment rates are basically almost an order of magnitude higher than asset assessment rates. So for most people, their EFC is dominated by their income. Reducing your income is almost always going to be counterproductive there's almost no scenarios in which increased aid eligibility would cover more than a fraction of the lost income. Tax deductions do not lower your EFC. In fact, they raise it a little bit. Less tax paid translates to lower tax allowances, which translates to higher EFC. That doesn't mean you want to get rid of your tax deductions. Net, you're still better off with those tax deductions than without, even if you were receiving EFC, full aid based on your EFC, which most people don't. But they are not going to help your EFC. And if you have if you have a big expensive home with a high mortgage, that's you're getting a large tax deduction from that is not going to help out your EFC one bit. The partial exception to, if you're a business owner, you may well be able to reduce your EFC because you have more flexibility around sort of timing of what's considered income. The FAFSA just relies on the net income that you report to the IRS. But that's probably not going to help you out either, because the schools that meet need are going to ask for a lot more information about the finances of your business, and they're going to scrutinize it a lot more closely. And even though you may have been able to reduce your net income by investing more money in the business or delaying invoices until after the year or whatever, that's probably not going to change what once the CSS profile schools get done taking a closer look at the financials they've asked you for. So if you can't reduce your EFC, there are nevertheless a number of things you can do that basically amount to shooting yourself in the foot if EFC matters. Again, for many people, EFC doesn't matter, and you shouldn't worry about these things. But if it does, these are all bad things that you don't want to do. The first is that if you are investing for college in a taxable account, make sure you realize any capital gains before December of the sophomore year of high school. In most cases, you'd be better off using a 529, so you don't have to worry about this. But if you've been investing for college for many years in a taxable account, and you have a lot of tax capital gains, the last thing you want to do is convert basically an asset into income and have it be assessed at a much higher rate. So do that before December of sophomore year of high school, and you should do that anyway, because if you have you don't want that money sitting in equities that this close to when you're going to need it. That's not good risk management. Okay, for withdrawals from savings that are treated as income, this is like Roth IRA distributions, don't take them until at least January of sophomore year or year 3 of year 5, so that they never, so that it will still be income, but it will be income that never hits your FAFSA. Don't have savings in your child's name. When you're saving for college, don't use custodial accounts. Save under your own name, because otherwise those assets are going to be assessed at a much, almost 4 times, potentially even more than the rate. The one exception to this is custodial 529 accounts. Even though the custodial 529 account, that's a 529 account where the student is not only the beneficiary but also the owner. Even though it's a student asset, technically, it gets reported and treated and assessed just as if it were a parent asset. So if you have a situation where, for example, a grandparent gave a bunch of money to your child in the form of a UTMA account, you might want to look into whether it's possible to convert that UTMA account into a custodial 529 account. One reason why it's probably not a great idea to do that in the first place when you're saving for your kids is that regular 529s are very flexible. It's a parent asset. You can transfer money. If you don't approve of where your child wants to go to school, you can decide whether they have access to that money or not. Custodial account, a 529 account, once the kid hits the age of majority in your state, they can spend that money however they want to. They can spend it to a college you don't approve of, or they can cash out, pay the penalties and taxes, and take a cruise. Unless you're comfortable giving up control, you probably don't want to take you probably don't want to be creating custodial 529s for your kids. Probably the single worst way to save for college is in the form of a EE savings bond, which is basically an asset that is very closely tied to the student. If it's been given to the student, it's like in their social security number. There's no way to spend that without cashing it out. They pay almost, especially at current rates, they pay basically almost no interest until they hit 20 years, at which they point they're guaranteed to be double the original value. In the meantime, by the time the student is 20, that's been an asset sitting on their EFC on their FAFSA for multiple years getting assessed. So if you well-meaning relatives give your kids savings bonds, cash them out and put the money in a 529. You can cash them out after a year. They won't be worth anything more than what was paid for them, but they won't be worth anything more than what was paid for them really until they hit 20 years. So that's a little rant. So the bottom line question really is, should I save for college? And the answer is a resounding yes. People always say, well, but won't that reduce my eligibility for financial aid? Well, yes, a little bit, but you should still do it. If your income is much above the median, you are going to probably struggle to meet your EFC unless you have meaningful college savings to draw upon. And those savings are going to affect your EFC much less than you likely imagine. The whole structure of the formula, high assessment rates on income, low assessment rates on assets, is designed to incentivize saving. And if you don't have college savings, you will be limiting your child's options, and you may feel that you have little choice but to take on affordable loans. Now, if your feeling is that, my EFC is $60,000 and that's an absurd amount of money to ever spend on college, why would I ever do that? No college should cost $60,000. That's fine. I'm not going to argue with you. And you could probably find options that cost considerably less. But, if you make that choice, you are crossing off the table, basically, a lot of top tier schools. And if you're comfortable doing that, that's obviously, I'm not going to argue that those schools are necessarily worth what they charge. But that's the choice you were making. If you want to be able to send your kid to any school they get into and want to go to, then you're going to be able to need to meet that institutional EFC. And for if your income is much above the median, probably the only way you're going to be able to do that is if you have savings to draw on. What about saving for retirement? Of course, you should do that too. Most people should probably be saving several times more for retirement than for college. And you should expect it to be very hard to keep saving for retirement while your child or children are in college. Again, because savings for retirement are not going to lower your EFC the way they lower your taxable income. And then, as I said a couple of times, they will actually increase your EFC a little bit, not a lot, but a little bit. So front load your retirement savings in the pre-college years. If you have a healthy retirement balance before your kids start college, that's going to leave you much better prepared to weather the storm of paying for college. In addition, a regular retirement savings habit is going to be a relatively painless way to free up cash flow for college. You just take those 401k deductions that you've been making every month, and if you're comfortable putting off more savings for retirement for a while, you can redirect those, and that's a lot easier than trying to cut your spending by 30%. And again, retirement savings in general will typically have no effect on financial aid eligibility. Now, some CSS profile schools do ask for that number to be reported, but as I understand it, is generally not assessed unless it's some crazy number. I don't know. I seem to recall that Mitt Romney has like a $40 million 401k through some sort of, if you're in that situation, you probably have other assets too, but I think that they probably would be assessing it. But if it's a reasonable number for an ordinary retirement, my understanding is that most schools aren't going to touch it, even if they're asking you to report it. Again, I can't guarantee that. Nobody can guarantee that because there's really, those formulas are fundamentally a black box. But that is my understanding of how they generally work. So that is my presentation, and I will be happy to take questions.
Thank you, George. Yeah, okay, wow, a lot of questions. I don't know if you want me to read them or I can, you can read, but here's a quick one. Should savings account money be transferred into a Roth? I guess that's in the kind of the idea of moving it into an asset. That's
they're
not
talking about
a
student savings?
That's a good question. Stephanie, you could clarify, but I'm assuming that they're talking about a parent.
If you can afford to do that,
yeah.
Yeah. I mean, if you can afford to if you don't anticipate needing to draw upon that money for college, sure. That's great. If you do anticipate needing that money, be very careful with that, because again, if you don't time it just right, that's going to just hit your EFC. And if it's the parents' money, you have to worry. That timing trick that I mentioned of waiting until January of sophomore year, that's not going to work if you have younger siblings, because it's still going to hit their FAFSA. The timing is pretty tricky to get right. So my advice would be, if you saving for retirement is great, but don't be very careful if you if you are not actually thinking of that as saving for retirement, but thinking of it as money that you're going to pull out for college in a couple of years.
And I mean, George, I don't know what you think about this, but the beauty of your spreadsheet is people can kind of, you can try out scenarios. So if you want to see,
that's what it's for.
Yeah. So if you want to see, well, what would happen if I did move that money to the Roth, what type of an impact is going to have on my EFC? Run the numbers on the spreadsheet, so then you'll know before you actually do it, and you can make a better decision.
So let me give one piece of advice about the spreadsheet I didn't think to give before. Be careful if you're playing around with your 401k contributions. Make sure that you adjust both places. So like you have to, or you could almost not adjust either. That will be pretty good. But what you don't want to do is have the AGI be your gross income, your salary, and then take your 401k contributions and put those in that box. And then, because if you do that, they'll be double counted. So what you really want to do to get the most accurate answer is take the 401k contributions, put them in the appropriate box, reduce the AGI by that, which is what your AGI really is. And this is a non-issue if you're using your actual tax return from 2019, because you'll have those numbers. They are what they are. But if you're trying to play around, be careful that you it's kind of like double ledger accounting. Like if you make a change in one place, you have to make a change in the other too. If you just add the 401k contributions to that cell, but you don't also reduce them to subtract them out of your AGI, then the spreadsheet is going to think that your income is much higher than it is, and your EFC is going to estimate is going to be off.
So I'm just going to address globally. There's a question here basically about what if your financial situation and your income has changed after your 2019 taxes, which unfortunately is probably going to be the case for a lot more people than ever this year.
So that's a great question. So in terms of the formula, like your FAFSA that you fill out this year for next school year uses 2019 income, that's it. But in terms of the process, like if you go on the education department website and you read about it, in terms of the process, there is a procedure for dealing with a change in circumstances. But that procedure doesn't go through the FAFSA really. It involves going directly to the financial aid office at the school. And they have the authority to use what's called professional judgment to basically adjust your EFC. And the point here that's kind of subtle, as I understand it, is that when they do that, they're not just adjusting your institutional EFC. They can actually adjust basically your FAFSA EFC. So like you can qualify for a Pell Grant on that basis if your change of circumstances has been sufficient. But it doesn't show up in the spreadsheet or the formula, because at that point it's not based on the formula anymore. It's based on the judgment of the financial aid officer at the particular school. And I assume that they would, basically be consulting the formula when they do that. I don't really have any insight into their process, but that is the procedure. Similarly, if you have unusual expenses, like high medical expenses, there's no place to put medical expenses on the FAFSA form. But if you go to the education department website, it talks about this, and it says, that your EFC can be adjusted based on medical expenses. But the path to do that is to go to the financial aid office at your child's school and have a conversation with them. It is not something that happens directly through the FAFSA.
And just one more thing about what George mentioned. Unfortunately, that's all going to happen after your student has been accepted to the school and they send you the financial aid award information. So kind of be ready, if you're in that situation where your finances have changed dramatically from 2019, and that could be a different webinar where we talk about kind of what you need to kind of get prepared that you're going to need to send to the college. But it's not going to happen until probably February or the March timeframe.
And I should add the warning that from my understanding, and this is more like just sort of what I picked up from the group rather than anything that I have learned officially. But like if a parent experiences a job loss or a loss of income, they usually don't want to talk to you for a while. Like if you lost your job yesterday, they're going to say come back in a few months. If you're unable to find a new job, 3 months from now they'll talk to you. Now, I'm not saying you shouldn't. I'm not at all saying you shouldn't go to them right away, but I am saying you should manage your expectations. And before you go, make sure you have all your documentation in hand. If you've got a separate, a statements of separation from your job or unemployment insurance, whatever the case may be, you'll want to be able to document it and have that, have all your papers in order before you go talk to the financial aid office.
Okay. Oh, yeah. Question about if a grandparent is paying the college bill directly, does that get considered to be a gift to the student?
Yes, it does.
Yeah.
The directions are very clear and explicit about that. There is, if the grandparent is paying the college directly, there's an exemption from gift tax that can be applied in that case. Although gift tax has such, gift tax there is only owed with really quite large gifts, but college tuition being what it is one of the kinds of gifts where it's easy for it to go above the threshold. So that is a reason to potentially have the grandparent pay directly to the college. But if you do that, it will affect the student's EFC in the out year. And again, conversely, if the grandparent gives the gift to the parent, that has no impact on EFC. They may have to worry about gift tax, but again, if there's two grandparents and two parents, they can together give the parents $60,000 a year before gift tax kicks in. And that's even before you start looking about like spreading it out over multiple years, which is an option in some cases too. But yeah, if EFC is going to be a factor, and assuming that the family dynamic is such that this is not a problem, the better way to approach that from an EFC perspective will usually be to make the gift to the parent and trust the parent to spend the money appropriately. Obviously, in some cases that may not be possible in certain family dynamics.
So there's a question here, and I see it sometimes a lot in the group, and kind of in this case, this person is saying that they're refinancing their home. They're going to get cash out, and they want to use that cash to pay off credit cards. And so it's really around the timing of different, sales of things, whether you're selling your house or selling stock, and kind of if that money is going to end up sitting in your account at the same time that you're going to fill out FAFSA.
Yep.
It could have an impact. Yeah.
Basically, if you're selling your house and buying a new house, you really don't want to file FAFSA during the interregnum. When at a time when you have all of the proceeds, all of your home equity is sitting in the bank rather than in where it's invisible rather than where it's visible and assessed rather than in home equity where it's ignored. I said in general, like you really probably shouldn't worry too much about the asset assessment rates because they are so low. But if you have that's one exception to that general rule is if it's at all possible, you really don't want to have to be filing FAFSA in between, when you've received the money from the sale of your old house and closed on the new house.
And so you
as far as
go ahead, George. Go ahead. Okay, George might have gotten frozen, but he'll come back, and I'll tell you what I'm going to tell you while we wait. So you have a little bit of flexibility, obviously, with the timing of when you fill out FAFSA, and if like any of these issues that we've just mentioned, where you might be getting money in, or maybe you have a big tax bill or something that you want to pay off before fill out FAFSA, you can make those timing adjustments. So, again, you do not have to fill out FAFSA October 1st, depending on, when your student is applying to school. If your student is applying in any of like the early decision or early action, there might be, and actually not might, there's probably likely a early deadline for financial aid forms. So, look out for that. You do want to file FAFSA, I'd say before Thanksgiving, but you don't have to do it October 1st. And if you are filing FAFSA for a student who's already in college, I think you actually have a little even more flexibility because, you know, you're not rushing to fill out the forms in relation to the admissions process. So again, if you have some bills that need to get paid and, you know, that might get, you know, take a chunk out of your assets, and your child is a sophomore through senior. So just, you know, figure out when that is and maybe when your lowest asset point's going to be, and, you know, fill out the FAFSA then.
Yeah, that's right. I'm self-employed, which means I pay, you know, I don't have taxes withheld from my paychecks, and I pay estimated quarterly taxes, which means that at any given point in time, a good chunk of the money that's in my checking account is often spoken for by the IRS. So, you know, if you're in that situation, for example, you know, it would be a pretty good idea to pay those, to make a tax payment, so that you're not getting assessed on money that you actually owe to the tax man,
Right.
even if that means paying earlier than you would need to. With reference to the question about refinancing and paying off debt, and like if it makes sense for you in general to refinance and pay off debt, that could well make sense. It's not really going to have any impact on the FAFSA calculation. The only time when paying off debt is going to affect FAFSA is if you're paying it out of assets that would otherwise be assessed. So if you're using the proceeds of a refi to pay it, that's money that was invisible before. You know, so I would say, you know, do that if it's what makes sense for you economically, but don't do it because you think it's going to have some impact on your EFC.
So somebody's asking about, are there any situations should the IRS data retrieval tool not be used?
Yes.
Yeah.
Yeah. So remember, I said that, you know, IRA withdrawals are income. So an exception to that is an IRA rollover. You know, if you take if you take a 401k from your old employer, if you've left a job and you roll it over into an IRA, that is not income. That's a but the way that those are frequently handled is that the custodian at your old job will send you a check, and you have 60 days to take that check and deposit the proceeds in your IRA. So the data retrieval tool, as far as I can tell, doesn't seem to know about whether that transaction was completed.
Yeah, and it's been happening for like several years.
It's something you'll hear a lot of complaints about every year. That people, you know, they use the DRT, their rollover got treated as income, and they had a crazy high EFC. If you weren't using the spreadsheet, you don't even know. You know, all you know is I have an insanely high EFC. You have no idea why. You know, the spreadsheet lets you understand what your EFC is, so that if it's wildly out of whack, you can figure out what's going on. And people who that happens to, that if they're motivated enough, they do seems like they can usually get it fixed, but it is not a fun process. You know, it's like a really so I would say if you did a rollover, I would definitely not use the data retrieval tool to enter those numbers manually. Personally, I wouldn't use the data retrieval tool, period. I just prefer to see my inputs. So that's not necessarily advice I would give to other people, but for myself, I do think that if you don't use the data retrieval tool, you're greatly increase your odds of getting, they call it verified, which is sort of like
it's true. Yes.
My understanding is that that's a pretty painless process. They just want to, you know, see some documentation, but I would not let that. Personally, I wouldn't let that stand in the way of not using the DRT. But for other people, if you don't have an IRA rollover, I probably wouldn't worry about it. The DRT it should be noted, is only the stuff that's on your taxes. Basically, it's only the income. It's not the assets. You have to fill that out yourself, regardless of whether you use the DRT, because the IRS doesn't know what your assets are. That's not information that's sitting in an IRS system somewhere.
So, and actually along that same point, this is again my personal consumer awareness comments. There are some companies out there that say, we will fill out your FAFSA for you. And I'm not talking about like a private, maybe an individual person who might help you fill out the FAFSA. But there's actually a few companies that have websites, and they say, you know, fill out our version of the FAFSA, and then we will submit it to the government. They do submit it to the government. Again, this is my personal opinion. Their business model is based on the fact that they want to know all that information about you. So that's why they're asking you to fill out their version of that FAFSA so that they can then send your information in. So I would be very wary. I personally don't think that those any of companies or offers are worth it at all.
Yeah, and it's really, unless your finances are complicated, it's not terribly hard to fill out. If your finances are complicated, then having someone else do it is not going to really help you anyway, because if you own rental real estate, for example, you're still going to have to come up with a value for that. It's if you have a business and you're required that isn't exempt, you're still going to have to somehow come up with a valuation of your business. And the places that will claim that they'll fill out FAFSA for you, they're not going to help you with that. So as long as you have your tax return, it really should not be hard.
So we could go on and on and on. And there's a lot of questions. I told you guys that I received an email today. So I'll try and look through all the questions, see if there's some themes to some of the questions, which there usually are, and we'll write them up. And as best we can, I'll try and get back to people with answers. But I think George, what you did tonight was fabulous. Your spreadsheet is amazing. Again, I think if I just encourage people to use it. The more information you have, the more confident you'll be about the process, more confident you'll be about asking questions. I just hope that you take the time to, dig in and learn a little bit. I wish everything was easier, but, it is the system that we're dealing with. So as best that you can arm yourself with the information, the better off you and your student will be. So thank you so much, George. People have asked this. This is definitely being recorded. I will send it out. You can watch it multiple times. I know that there are people who couldn't make it tonight. They'll receive it as well. Any last parting words, George?
Thanks for listening, and good luck.
Okay, everybody.
Good night.
Good night.
Thank you.
Thank you. Bye-bye.
Bye.
Thank you.
Thank you, George.
You're welcome.
Have a nice evening.
Thanks.
Okay.